First of all, I will briefly explain about MFRS134 Interim Financial Reporting. First, it refers to financial reporting for periods that are shorter than a full financial year, such as quarterly or half-year report. This allows companies to provide timely financial information to users. MFRS 134 provides guidelines on what information should be included in interim financial reports. This ensures the reports still contain relevant and useful information for decision making. In addition, companies can prepare either a complete set of financial statement or a condensed set for interim reporting. In practice, most companies prefer the condensed version because it is more efficient and practical. MFRS 134 also includes disclosure requirements as well as recognition and measurement principles. This means companies must follow proper accounting rules when preparing interim reports. Lastly, the standard ensures consistency and comparability of financial information across reporting periods so users can compare performance over time. Overall, MFRS 134 ensures that interim financial reporting is consistent, reliable, and useful for users.
For this slide, I will explain Nestle strategic expansion. Nestle Malaysia set up a global production hub at Sri Muda for Nescafe Espresso. This expansion increased their property, plant and equipment because of high investment in new machinery. At the same time, it helped boost export revenue. But in the short term, it also led to higher depreciation costs. So overall, the expansion supports growth but comes with higher short-term costs. Next is cost optimization and digitalization. Nestle uses efficiency programs and AI technology to manage rising raw material costs like coffee and cocoa. They also maintain strong cash flow and liquidity, meaning they rely less on external debt. Because of this, Nestle is still able to keep its profit margins stable even with increasing costs. So, this shows good cost control and stable performance.
In the overview of current and comparative interim financial statement, this table highlights the reporting period for different components under the interim financial reporting framework. For the statement of financial positions, at the current period, it covers as at 30 September 2035, while in comparative period, it covers as at 31st December 2034. In statement of profit or loss and other comprehensive income, it divided by 2, which is quarter and year to date. In quarter, it covers at 1st July until 30 September 2035, and at comparative period, it covers at 1st July until 30 September 2034. On year to date, for current period, it covers 1st January until 30 September 2035, and for comparative period, it covers 1st January until 30 September 2034. Other than that, statement of changes in equity, in current period, it covers at 1st January until 30 September 2035, and comparative period, it covers at 1st January until 30 September 2034. While in statement of cash flow, the current period and comparative period is same as the statement of changes in equity date. And these are statements of financial report in the Nestle Berhad. So first of all, we got statements of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, and statement of cash flow.
Alright, for this slide, I will explain what an operating segment is based on MFRS 8. An operating segment is basically a part of a company that meets 3 main criteria. First, it must be involved in business activity where it can earn revenue or incur expenses. This includes transactions between different segments within the same company. Second, the performance of this segment is regularly reviewed by the chief operating decision maker. This is important because management use the information to decide how to allocate resources and evaluate performance. Third, the segment must have separate or discrete financial information available. This means its financial result can be clearly identified and measured. However, not all parts of the company are considered operating segment. For example, the head office and the research development department are usually not an operating segment. This is because they are not directly generate revenue. Instead, they mainly support other part of the business. However, there is an exception if this department actually carry out business activity. For example, if the head office manages treasury function and earn interest, they can be considered on an operating segment.
So here, I will explain about the Chief Operating Decision Maker or CODM. The CODM refers to the individual or group that is responsible for making key operating decisions in a company. This role is very important because they directly influence how the company performs and grows. Their main responsibilities include allocating resources across different business segments, such as deciding which segment should receive more investment or support. They also evaluate the performance of each segment by reviewing financial results regularly, such as revenue, profit, and costs. Based on this evaluation, the CODM will make strategic decisions, for example, whether to expand, reduce, or improve certain business segments. This ensures that the company focuses on its most profitable and efficient operation. In addition, the CODM relies on segmental financial information to compare performance between segments. This helps in identifying strengths, weaknesses, and potential risks within the company. Overall, the CODM plays a crucial role in ensuring that resources are used efficiently and that the company achieves its overall business objectives. As we can see, this slide shows an example of CODM in publicly listed Malaysian company, which is Spritzer. In this case, the CODM includes Lim Kok Cheong, who is part of the board of directors, and Kenny Lim Seng Lee, the group CEO and executive directors. These individuals are responsible for reviewing the company's segment performance, making key decisions, and ensuring that resources are allocated effectively.
There are two types of segment report. The first of all is business segment, and the second of all is geographical segment. So for the business segments in Spritzer Berhad, the largest one is manufacturing, where they manufacture the Spritzer water bottles and the sparkling Spritzer water bottle, with the revenue of 554 millions, with the segmental result of 83 millions. And others, which is trading, where they trade the Spritzer water bottle, with the revenue of 23 millions, and the segmental result is 955,000. And others, including property development, recreation facilities and investment holding, with the revenue of 1,581,000, with the segmental result of 23 million. In geographical segments, Spritzer has a very little business outside Malaysia, which is less than 10%. So because of that, there's no need to show asset and capital investment by the country, and there's no need to show revenue by the location, which is export sale. So under MFRS 8 rule, if something is less than 10%, it is not material, so there's no need to disclose.
For this part, I will discuss two benefits of segmental reporting, which are: first, clear identification of main revenue drivers, and second, informed risk assessment and resources allocation. The first key benefit of segmental reporting is that it allows users to clearly identify the main revenue drivers of a company. For example, in Spritzer segmental report, the company separates its performance into segments, such as manufacturing, trading, and others. From this, user can easily see which segment contribute the highest revenue. In Spritzer case, the manufacturing segment from the primary contributor, especially from bottled water product. This helped investor and analysts understand where the company is actually making its money instead of only seeing total revenue. So, segmental reporting improves transparency and gives a clear picture of a business performance.
Lastly, segmental reporting. This helps users to understand business performance by looking at each segment separately, which improves risk assessment. For Spritzer, most of its revenue comes from one main segment, showing high concentration. This creates a risk of overdependence where any cost increase or disruption could affect the whole company. At the same time, this information helps management to make better decisions and allocate resources more effectively. So overall, segmental reporting gives a clearer picture of risk and performance.